So I think what's made us better is when I started this business, because I've been in the business my whole life, and I said we're going to have a Wall Street quality research department on the buy side. And a lot of people say that, but they take the brokerage report and just paste on the top of theirs. So I have hired guys that have very good experience in the business. And so we do all of our own research. We have 12 analysts in the space, which is, I think, more than anybody on the buy side, and I know anybody on Wall Street does. And the reason we do that, and we have very detailed 40-page models in every company, and the reason we do it, because it still makes us money. So I think where some of our competitors, and this isn't bad, have taken the approach of having a very index kind of no turnover, no active management approach, and that worked for a few years. But our approach is bottoms up, fundamental stock picking, adding alpha to the portfolios with a very healthy risk management overlay on top of it. And so that's the way we've chosen to differentiate ourselves. We have a lot of our personal money in this, and we are out to make money for investors every day, not run a passive index fund. So we have a very robust investment process. I think I have the only certified financial risk manager, FRM, in the MLP space. So we take it very serious, and a couple things. So from the fundamental side, we try to mitigate the risk from this in-depth fundamental research, income statement, balance sheet, management, contract types, commodity exposure. So from the fundamental research side, we try to keep those company risks there. On the portfolio side, and a lot of people say we have both a bottoms-up and top-down approach. The top-down comes from periodic themes. So like I said, in 2010, it became evident to us that we wanted to skew our portfolios to the crude oil side, and we did that. That play's kind of over. Last November, some things happened. Approval LNG, it said, listen, we need to be involved in everything involved in the LNG. So that was a thematic approach. But the same thing that happened on the crude side, from the bottoms up, almost 80% of the time, what we're seeing from a macro, our analysts are already seeing the company side. They're already seeing the fundamentals come through. So I would say 80% of the time, the top down and bottoms up mesh. So on the crude side, it happened very interesting, and we made a lot of money. That trade was worth 150% versus what we sold. On the LNG side, it's the same way. We want to be involved. Every MLP, we've had shipping companies, shipping MLPs that are involved in LNG, so we've done that. So it's basically robust, top up, bottoms down. Here's where we want to be. And on top of that, our risk manager, and the couple things I would say on the risk. So a lot of people just think of a risk manager as a quant sitting in a room changing stuff. Well, we got that. But I'm telling you, the risk management isn't completely permeated in the portfolio managers. So all these guys have been with me since '08. So we've been through it. We've been through the fire together. And these people, so the portfolio managers themselves would never take risk. And on top of that, my risk manager works every day to make sure we have portfolio liquidity, appropriate for sizes, and we have diversity. And so we have a very, very liquid portfolio. If you take a look at our mutual fund liquidity measures we do, it is dramatically more liquid than all of our competitors, because we know that in a mutual fund, although we've had massive increases in flows, we could have redemptions, and we want to make sure we can meet those. So we have a very high performing fund with a whole lot of liquidity, and we will not have huge positions in small illiquid stocks.